Well, hello everybody. This is the final installation on the investment property renovation series that many of you have been following for quite some time now. I'd been asked periodically throughout the series if I was going to reveal the financial side of the project, and my answer was always yes. I always fully intended to do that. But unlike the television shows where they use fuzzy math, in my opinion, I'm going to be using real world numbers straight out of my books on this. So this is the absolute truth on this project from start to finish. The TV shows many of you I'm sure have seen, they use fuzzy math, in my opinion. They'll make broad sweeping statements like, we picked it up for $50,000, we put $50,000 in it, we sold it for $200,000, so we had a profit of $100,000. Yeah, maybe growth, but not when it's all netted out and all expenses have been taken into consideration. So they're fun, entertaining shows to watch here and there, but here's a real world example on a real world project from start to finish. Along with covering the books, I am going to go over some of the back end things on maybe setting up a business to do this very thing. I'm going to go from start to finish on this. It's going to be quite lengthy. It may be lame to a lot of folks that are not interested. So if you're not interested, feel free to tune out. And if you are, let's take a peek. Alright, well here we go. This list right here you see are basically some of the items that I have done to set up the business and get underway with it. I'm not going to go hard off into any one of these topics. I'm just going to briefly comment on each one. Setting up a business structure. That's very important. In my case, I formed an LLC in the state where I reside, and that's where I hold properties and where I conduct my business for these types of situations. You also need to obtain an FEIN number. That's a Federal Employer Identification Number. That's for tax filing status. You can get that from the government with a simple phone call. And then set up a business bank account. They're going to need that FEIN number to do that. So I've got a bank account set up. That's where the funds are initially put into the bank and then used for the project. Now, do not commingle funds. That's very important to separate your business and your personal holdings and activities. You do not want to do that. The main reason is, in the event that you get sued for any reason and it can be proven that you have been commingling funds, they could actually pierce your corporate veil and hold you personally liable. So that's what the LLC is for, is to limit your liability in situations like that. Now, not commingling basically means do not pay for anything personal out of a business bank account. And likewise, don't pay for business expenses from your personal bank account. All transactions need to be separate from one another. So if I need something for my business, I may buy it from my personal account, but I will expense it in the form of a payment back to myself as a check out of my business account. So I'll do it indirectly like that, but just don't commingle. Get an accountant. Very, very important. You need to find an accountant to especially do the tax information for you to where you can send it all off. I personally do my own bookworking, my bookkeeping, but I always pay the accountant, and they'll help you set up the books. Where it says properties are works in progress, that's very important. As an example, I buy a property, let's say mid-year in July, and I get the property almost completed by the end of the year. If I expense out all of that money and offset it for my taxes for that particular year, when I go to sell the property in the following year, I'm going to lose those deductions, and I'll show a larger capital gain for the property, and it's going to be a bad move on my part. So the way my properties are held in my books is they are works in progress. Nothing is expensed out or written off until the property is sold. And in that calendar year, that's when all the expenses are offset against it to help minimize and actually take full advantage of the tax obligation that you're going to have. So it's very important to do that. So on this particular property that we're speaking of, even though it's been, let's say, 2 years back, I've not claimed any expenses on that yet. Since it's sold in this calendar year, everything that's gone into it will be offset or written off against it. I hope that makes sense. Keep accurate records. That is very important. Be very well organized. Keep your books tight. Make sure you get all of the information in there and recorded and accounted for in the proper place where they go. It'll make your life easier, and it'll make keeping your projects in line easier because you'll know exactly where you're at. Locate an insurance agent. That seems pretty easy to understand, but you need to locate one that you can work with on short notice where they can potentially write you a policy while you're on your way to close on a property. So you do need that for insuring properties. Now, the property insurance is really not that bad on investment property because it doesn't take into consideration your personal possessions and things like that because it's not your primary residence. So the policies are really affordable in my opinion. Locate an investor-friendly lender. That's fairly important as well. You need to make contact with someone who works with investors, knows what you're doing, and who is friendly at lending you money on financing deals like this. You are not going to go get an FHA loan as an investor. It's just simply not going to happen. So you need to build a relationship with that lender or a person within there. And that's where I do my financing. And then lastly, get to work. So let's get to work. All right, well, let's start digging into this spreadsheet I've created. I'm not going to release this publicly, but there should be enough information in here nonetheless. This is how I analyze properties. Now, keep in mind, this spreadsheet has been an amoeba. It has been changing. It has been redone. I could tighten it up. I could use better formulas, but it works. So we're going to drive through this thing. Excuse me. All of these light colored highlighted fields here, that's where I input data. Everything else you see has been calculated with formulas and whatnot that I've created. So I'm going to start at the top over here and work my way down. Okay, this is how I analyze a property. I take a list price, what they're asking for it, and I key it in there. Normally, I would start with that number again in the purchase price field. So let's do that, 62.5. So I've not reduced that amount by anything or any percentage right here. The down payment is typically 20% for an investor. So that's what I have to put down. The closing cost here is an estimation. I've put in 3% as an estimate. Those figures are known after it's closing, so that's just a guess. And this is the amount that would be financed right here, $50,000. This rehab costs is my guesstimation on how much it would take to renovate this property. If I rolled everything up and it was 100% financed, that's how much I would have financed right there. Now this after repair value, or ARV, that's what I think I can get for the property when it sells. That's a critical number that you know. You get that through comparables, comps. You can try to do your own comps through websites like Zillow, for example, and I do use it, but pay no mind to their estimates. Don't look at that at all, and do not look at what people are asking for their properties. You always want to look at what has sold. The more recent, the better. Say 90 days, 6 months. If you can't get good comparables in that time frame, you may take it out to 12 months. But that's where an agent comes in beneficial. They can run comparables for you, and then you can make a determination of what you think the after repair value will be. And now you need to look at apples to apples. There's going to be high numbers of recent sales in terms of dollar amounts, and there will be low numbers. You need to look at the quality of them and look at them individually. But you come up with that figure. And let's say for this example, I put it at $155,000. Now this gross profit value here, this 70%, it's a rule I read about some time back. And I just keyed it in there. It's been here forever, and I just leave it. But basically, it will tell you, in essence, what your maximum allowable offer should be. And in this case, they say $78,500. That should take care of expenses and whatnot and still leave a little bit of profit. I don't rely on that wholly, but I do just glance at it from time to time. So in this scenario, using the MAO or 70% rule, it would have a potential gross profit of $46,500. Moving down here, I need to know what the insurance is. That's just a good best guess estimate after speaking with my insurance agent. The current property value taxes, and let's say they were $1,120 right here. I might increase that by a couple $100 based on whatever the county assessor's saying, because they will go up. And interest per month right here. You can see where it says lender. That in my spreadsheet basically just means is I'm only using my lender to finance the purchase of the property, not renovation costs or anything of that nature. And then you can see this interest per month and a HELOC. That's a home equity line of credit. That's actually a line of credit I have on my own personal home. And if I choose to use it to renovate a property, that would be my monthly interest rate there. And here's how much it would be for the lender only. Utilities per month, just keying in a $300 for a figure. Carrying costs per month, lender only, so they would be $625. That would account for the insurance, taxes, and the interest per month on the lender. And then carrying costs including the HELOC, that would include this payment here as well as the other things I just mentioned. And then carrying costs per month all cash, that's assuming, or as an option, if I did the entire project using all cash, start to finish. That's how much my monthly carrying cost would be. Now, where people make a mistake is when you're analyzing a property, you need to analyze it through the sale and close of it as well. And you need to account for those expenses before you even purchase it. And they're right down here. The standard 6% sales commission is going to apply right here. So in the event I sold this for $155,000, that's how much I lose in commissions right off the top, $9,300. And then the seller closing costs, I've got 1% as the figure in here, and in my case that's really close to being accurate. Now here's another one that has to be taken into consideration or you might get blindsided on the back end. It is not uncommon for potential buyers to request you pay a portion of their closing costs when they buy the property. Some folks may not have enough money laying around, so it's a way for them to get into a property with your help. If you're going to allow that, you need to know how it's going to affect you on your bottom line before you even purchase the property. So that's pretty much the rundown in that line. Now we're going to move over here into this section right up in here. And then this holding months across the top, you can see they start at 2, moving from right to left, and they end up on 6 right here. This is basically how many months, if I held it for 6 months, meaning I purchased it, closed on it, renovated it, and closed on it again at the 6-month mark, then here is how much I would have paid out for insurance in that time frame, the taxes in that time frame, based on what they cost per month. And then right here, I would have had $1,000 in interest-only payments. And if I was using my home equity line of credit for this rehab and closing and everything as a whole, then it would have cost me that. And then, of course, the utilities for that time frame, and etc. Now, I change this number depending on what I want right here. Let's say I took it up to 12 months. It adjusts all these automatically. I'm just going to leave it there for now. And then down here, this is where I'm really focusing in on this analysis. I've got 3 categories here. This one, I'm only financing against the property itself. And there is my net profit, so to speak. And then down here, if I did it all, including my HELOC, all financed, then I would be sitting here at about $40,000 on this analysis. And if I went all cash, I'd be positive about $4,000. So that just gives me a quick look on different ways I might get into it and see where I'm at. Now, this section down here is assuming I am paying the closing costs for the buyer, this $5,000. So it's just a direct reflection of these minus $5,000 for each of that. And then down here at the bottom, I've got break-even months. That's in this scenario, if everything held true, I could hold this property for, or hold out, so to speak, for that $155,000 for roughly 78 months. And then, you know, it goes up, et cetera, et cetera. So that's the general rundown on this first sheet. Now, I've got other sheets along here, and I will be going by them one by one and the differences, and then we're going to get to the end here, the final numbers. All right, before we move along, I wanted to explain something about this particular sheet here. You can seriously get yourself into trouble with something like this by being too optimistic and manipulating the numbers in a way that looks favorable, but they may really not be that way. So let's go in and we'll change this back to 6 months. That's how long we anticipate holding a property. And let's say we locate a property and they're asking $75,000 for it. And I'll key that in here. And then I'll move down and say, well, this property, after looking at it, is going to take $25,000 of rehab. But we've determined the ARV of this particular property is $120,000. That's what we feel we can get for it on the market. Now you can see here in this particular scenario with 6 months, we're getting tight over here by $5,000 in this scenario. But if we take into account a seller paying the closing costs for the buyer of $5,000, you can see we're really in this scenario getting really close to being a loser. So what can happen here? Well, let's say we have a budget overrun and we actually hit this at $30,000. Well, you can see now we're a complete loser down here, and we're just a slight winner up here, but not enough for my comfort. So let me back that out. Another scenario that could happen here is we don't hold it for 6 months. We don't get it completed. We hold it for 12. Now you can see we're an absolute loser down here, and we're getting close in this scenario to being a loser. So it's very easy to manipulate these numbers to where they look rosy. Let me back that out. So what can we do here? Well, of course we can reduce what they're asking for, which in most cases you would. But if we take into consideration this maximum allowable offer here of $59,000, let's just key it in. You can see it looks really good here in both directions. You know, we've got $22,000 here with a $25,000 budget, or down here if we let loose of $5,000 to help somebody get into the property, we're still at $17,000. We could potentially go $3,000 on this, and of course that's going to affect our bottom line directly. So let me back that out. Now if they're asking $75,000 and we come in at a a offer of $59,000, we're cutting them off the knees by 21%. There's no hard figure on what someone might accept or what is an insult, so to speak, but in my opinion, I wouldn't even make an offer like that. So I would, at this point, if I was interested in it, trying to find a way to make it work for me, but not stretching it so much where I'm doing so much manipulation in here, it may not turn out in my benefit. So if I was reasonable and I said, okay, well, we're going to come in at 70,000, and let's say they were going to accept that. We're only asking them to take off about 6% of what they're asking. I think that's reasonable and intact. But now you can see we've got 10,000. If you are going through a lot of properties and volume, this is a deal you might entertain, even if you're down here at the 5,000 mark. Paying for some seller costs. If you're shuffling papers and not, really doing all the work and you're just writing checks, I might entertain that. If I get to that level, then these are going to be properties that I will look more hardly at. But even in this scenario, if we have a budget overrun, and let's say we're at $30,000 when it's all said and done, we're still okay. We've still made some money in that scenario, but here we're almost a loser. So then we have to try to figure out how to negotiate this out to at least make something. So if we say, no, we're not selling any of that, we're not paying any of that at all, and we hold out for that particular buyer, we're going to be exactly right up here. Now this $5,000 here, that's if they ask. You don't advertise that and say we're going to pay up to this. You wait till they ask. But at least here, having it in here, if they ask for it, where you're going to sit. Long story short, it's very easy to make something that looks like a dog initially into a racehorse winner. That's not the objective. Like I said, I'm fairly conservative with my numbers. I like to have padding and leeway. So if I'm blindsided, have budget overruns, or maybe the ARV changes, the market has a dip, then I can account for it up front and I still come out a winner. Let's take, for example, that we back a few of these out and we're sitting right here at 10. That's at 6 months. Let's change that to 12. Still maybe not a bad deal, but if there is a dip in the market and our 125 is now 115, we're still a reasonable winner up here in that scenario. But if we have to hold it for 12 months, we're still winning, and down here we're a loser. The point is, and what I'm trying to illustrate here, is you have to kind of get your head around this and figure it out, because it's very easy to almost make anything look really good. All right, we're on the post-closing sheet now. This is after purchasing the property, and we've got some real numbers. In that first sheet I was showing, I deviated off the actual numbers a little bit because I was showing some examples. But we did purchase the property for $58,000. And when I received the closing or settlement statement, my actual down payment was actually 15.67%, or this dollar amount. And the closing costs, even though I put in 3% there, actually turned out to be 4.78 because the lender rolled some things up into the note. The financed amount was, I believe, $46,000, and it ended up $47,500 here. So that increased that number. So pretty much instead of 23%, I only really outlaid 20% roughly. So we financed $47,500. These are all taken off the settlement statement, and this is what I took to closing via check. Now this rehab cost, this is where I really start tracking my investment and what I'm putting into it. This is a number that escalates over time. I'm going to make a small amendment in here at some point to include my rehab cost estimation and then have kind of a running tab here. And at some point in time, I will switch that around to where it starts reading off of this. But the rest of the spreadsheet's exactly the same, but I'm getting a little bit more hard with my figures in here. Now you can see here on utilities per month, it's $124 instead of the $300 that was speculated on the first sheet. Well, that's after being there 2 or 3 months and taking an average. So that's really what our average was in a certain time frame, was $124. Everything else pretty much the same, but you can see here this holding month is still at 6 months. We came to that, we crossed that, and each month I crossed that, I would escalate this number by 1. I believe we ended up at 21 months on this particular project, okay? And I've also got the same ARV here of $145,000, which was our speculation. We did well better than that, and it will become clear later. But in this scenario right here, up to this particular point in time, you can see that we had a potential profit here of 33 and change by the way we structured this deal. Alright, like I said, this is really the sheet where I keep things up to date and pull things out from time to time. This particular area on this house had started rising up in value, so it was actually a big benefit to us. So this speculation here on the ARV kept rising and rising and rising. Now when we went to put it on the market, of course I shot for the moon because I was going to let the market tell me what it was going to be worth. So we actually listed the property at $164,900 just to see what would happen there. Now you cannot just cherry pick a number here, and I'll explain what I mean. The old adage is something is only worth what someone is willing to pay for it. And that may be true in a lot of cases until you get a lender involved. And this will come into play a little bit as I progress with the video. But what I mean by that is, if a property is truly worth $150,000 and someone is willing to give you $500,000 for it, they better have cash. Because if you're using a lender, that lender is going to make an appraisal on the property, and if it doesn't appraise for the asking price or sale price of $500,000, they're not going to make a loan on it, or you are going to have to come up with the difference. So keep in mind, even if someone's willing to pay something for that, that does really not mean that's what it's worth. So as we were moving through this, the ARV was moving up, moving up, moving up. Everything was looking good, and it turned out good in our favor, of course. So in this type of situation, we ended up at 21 months that we actually held the property. We listed it for $164,900. We allotted $5,000 for buyer closing costs. So you can see this 51 here on lender only. That's not where we ended up, but that's where we're at right now. Alright, well the next sheet in my workbook is for negotiations. And this is when someone submits an offer to me. I can do an analysis of it quickly and counter offers, counters, accepted, this, that, and the other. Now, like I'd said, we shot for the moon on listing this property. We priced it high to let them set the market. We actually listed the property just before the Memorial Day weekend this year. I believe it was a Thursday. So we lost a little bit of that time. We had a lot of activity, some tire kickers, and it took 19 days to get it under contract. I felt that was pretty good, especially for where we came in at. So kind of running down this here, this is, again, these light colored fields are where I input actual data. Okay, we listed it at 164.9, as you can see here. We had an offer come in at $160,000, and they requested $5,000 of closing and prepaid paid by us. So that basically was a reduction amount of $9,900 off of our list, or 6%, for a total offer price from our perspective of $155,000. So moving down through here, of course, we had a 6% for sales commissions and 1% of our closing costs. And then, of course, we take into account our loan payoff. And here's our estimated net to seller, which was us, $95,982. Looks good, but now we have to do some more math. We need to take off our expenses. So this is the hardcore number of what it cost us to renovate the property. This was the interest paid on the note, the insurance we paid, the property taxes, the utilities. Our down payment and closing costs here are recouping our initial check that we had to take via cash to closing to purchase the property. Miscellaneous items, gas, etc. Now these are items that, gasoline for example, in my books I'm writing off actual mileage, not the actual numbers or dollar amount that was spent. You can see I've got $35.75 here. The gas, etc., that's what it cost me. But on my books and tax filing, it's going to be more like $7,000 to $8,000 where I'm writing that off or offsetting that. But I'm using real numbers here. So I had a potential net profit here of $38,039. I'd mentioned earlier about the listing price, and I shot it to the moon. But what I was concerned about was it not meeting an appraisal. And if it comes back not meeting an appraisal, then you've only got really two options. If it's a FHA loan, I believe, if the appraisal comes in too low, it sticks with that property for quite some time. However, this purchaser was using a conventional loan, so in the event the appraisal came in low, it would not stick to it. You have to look that up on your own, but that's the way it goes, I believe. Now also, the offer that came in here at $160 was contingent on their property selling, meaning they said, yes, we want to buy your property and we're willing to give you this much for it, but if our property we have on the market does not sell or follow through with closing, then we're out. So you have to keep that in mind, and that's not an uncommon thing that happens. So they did issue the paperwork and the contracts that it was under contract, their own property, but there was no guarantee that they would follow through, nor them follow through to ours. So that's something you have to take into consideration. So I sent a counter offer in. I did not want to elevate the price, the sale price, because of the appraisal situation. So in lieu of that, I was originally countering at $2,500 instead of $5,000 to say, all right, well, there it is. But I said, let's give them a little bit more meat. So I counter offered with a $3,000 closing in prepaids. So that reduces me here to $7,900 from the actual listing price, or $157 even on what I would be paid. So a gain of $2,000 in my favor. Everything down here is exactly the same as well as down here. Now when we meet to the bottom here on the potential net profit, you can see I've gained in my counter exactly $2,000. Well, here's what happened that I did not want to happen. They basically saw this total offer price of $157,000 as my acceptable offer had they taken it. So they're like, well, we want the property. I'm like, well, if they've got one under contingency, I've kind of got them where I want them in negotiations because, one, they wanted the place. Two, how many options did they have? Three, who would accept a contingency on that? So they already had theirs under contract, so I knew I kind of had them up against the wall. It's just negotiation skills. So they came back at $162,000, which I did not want to see, to get their $5,000 of prepaids. The reason behind this is they wanted to take some cash away from the table to put in a fence, and I understand that. But I was really concerned about the property not meeting the appraisal. So I went ahead and accepted the offer right there. But what they look at, when I say they, I mean the buyer and seller agents, they saw here $157,000, which is what I wanted in that offer. So they're like, well, let's just restructure the deal so he gets what he wants, meaning me, $157,000. And I even said in the conversation, well, that's great and it looks that way up front, but that changes the dynamics of my commission costs and my closing costs because it's based on the sale price. And you can see it right here in real time. With this structured deal here, which would look better for appraisals, and I end up at 157, I'd have 96 and 1600. But over here, seemingly the same deal at face value cost me 9720 or 1620. Not a lot of money, but the agents didn't quite understand what I was saying there because they're not in my books and in my head. Everything else pretty well stagnant all the way down. So you can see by looking at this down here on net change offers, when I countered with $2,000 in my favor. When they countered back, I was minus 140 because of the discrepancy in the sales commissions and closing costs. So I did get a net change in my benefit of $1,860. Every bit counts. So I accepted that offer. And we did make it to close and everything went just fine. So here's the accepted offer here. Everything's pretty much the same as the line next to it. But if I have to go back and forth a time or two, I'll just amend these columns to get where I want. But this is just a quick way for me to key in information and see the net results. All right, well, the next worksheet in my workbook is the selling timeline. I personally read all contracts that I engage in, and I understand them fully. This is just simply a way for me to track what's supposed to happen and on what date it's supposed to happen by. The yellow highlighted fields here are dates referenced where I should receive information pending the contract. And if I don't with any reason, I could potentially get out on my side if need be. But in this case, everything went swimmingly. But just general information here. You can pause the video and read it all if you like. Alright guys, well, we're coming down the home stretch here. These are the actual numbers start to finish. Pulled out of my books, everything has been accounted for, and here we go. I was concerned about the 162 not appraising. Well, it did. It came in fine. So everything worked out fine there. These were our commissions that we paid, the 6%. I'd mentioned we had a buyer closing costs, paid for them, up to $5,000. Well, they were not able to allot all of it, so there was a little bit left on the table that went back in our bucket. Not much, but some. These were the actual closing costs from our end to finalize the transaction, which I had been estimating 1%, and you can see I got pretty close here. The prorated taxes here are what I needed to be basically paid back for, since they own the property from, let's say, July, mid-July on. I needed credit for that unused. So there it is right there. The loan payoff that we had, and this is the cash at close, basically the check we took away from the table. Looks really good, right? So now we're going to start deducting down to the bottom line. Real numbers. This is exactly what we spent on the renovation cost for that property, $32,908 and change. This is what we paid to the penny for the interest on the note for the length of time we held it. The length of time of interest was right here. The property taxes right here. Utilities here. The down payment and closing costs was basically the check we took to the table to purchase this property. We need to account for that and make sure we get it back, right? The miscellaneous gas, etc., I mentioned that in the last clip, I believe. And then there is our net profit. This is how we did on that property prior tax with real numbers. There will be a tax implication that comes out of here. We will have capital gains on it that we have to account for, but it won't be based on this number. These were the real numbers, not the ones that are going to be submitted. Now, these are the numbers after receiving even back deposits, portions of insurance, and things of that nature. So for utilities, for example, we had to put some deposits down to get them turned up. If there was any balance remaining, it came back to us. And the same with the insurance. You know, we pay that up front, and whatever was left prorated behind that point, we receive those numbers back. So this is the bottom line on this project. Real world numbers, no messing around. I hope this helps you guys at least see what it takes in terms of the back end and everything else that goes into something like this on a project. Thanks for watching, guys, and good luck.